Thank you very much um, for the privilege and the opportunity given me to be here today. I quite really appreciate it. Um, I would love my thinking was I would love to be physically present in Lagos for this rather than doing it virtually. Unfortunately, I wasn't. I had to travel today, but it's a privilege to be here. I just want us to kind of pray very few for about seconds or two before we start. Everlasting Father, we appreciate you for this privilege to come into your presence. Holy Spirit, as we speak today, Father, we want to hear your voice. Lord, I submit my will unto your will, my understanding to your understanding, in the mighty name of Jesus. I want you to minister to your people and speak word of wisdom and word of understanding. It is not my voice that's going to be here today, but the voice of God and the voice of the Holy Spirit. In the mighty name of Jesus. Amen. Where are we going to start? I'm going to start from, I divide my slide into about 5 major areas. And it's going to be, the first one is to define what exactly we mean by taxation. And the second one to look at the different types of taxes and levies we have in Nigeria. And then we'll be looking at how to develop an effective tax compliance framework and what are the benefits of developing this tax compliance framework. And obviously, there's going to be opportunity to ask questions. It's going to be more fun. I think we're going to do better when we're able to ask questions. So what do we actually call taxes? I think that's one of the areas that we need to kind of ask. What do we mean when we say taxes? What exactly do we mean by taxes? I'm trying to play on my screen. So taxation in basic terms, we say is the imposition of compulsory levies on individuals or entities and goods and services by the government in almost every country of the world, in which the primary purpose is to raise revenue for government expenditure. Now, this is quite consistent, and we can see in the book of Matthew, chapter 22, verse 20 to 22, where Jesus Christ said, "Render unto Caesar the things which are Caesar's, and unto God the things which are God's." Now, obviously, in some part of the world, like in Europe, for example, in the United Kingdom and the United States, there's a joke that is very common, and the joke is there are only two things that are certain in this world: death and taxes. I know in Nigeria we haven't really gotten to that level, but gradually we're getting into that level. Now we've seen some countries like in the Middle East, when you go to UAE, Dubai, Qatar, and some other areas, they don't used to. In the past, there was nothing like taxes. Everything was, you just walk and you go because it's considered according to the faith or the practice that they were practicing, that taxation is a sinful thing. And now we've seen probably some misinterpretation, I'll call it, or maybe interpretation in the Bible that say taxation, probably, the Republicans, as they call them, are considered to be sinners. But for government to be able to raise capital, to raise revenue, for them to perform their activities and to manage their expenditures, then it is very important that they levy taxes. Now, I just want us to kind of flow into this conversation gradually. And so this is just defining the basic definition of taxation. We're going to go in slightly into what the type of taxations we have in Nigeria. In different countries, most of this taxation are be common all over the world. Citizens of most countries in the world are expected to comply with applicable tax legislation in their country, and Nigeria is not different from this. So what type of taxes do we have in Nigeria? I'm just going to look at some that are applicable to us. Not everything could potentially be applicable to us. For example, I'm not going to go into petroleum profit tax because I don't really see that as a form of specialized taxes. that might not cut across everybody. So we're going to look at about 7 or 8 forms of taxes and levies. We have the company income tax, which is called CIT. And we have the payee, which is pay as you earn. We have VAT, value added tax. Funnily enough, we have the police tax. I'm going to come into that. We have education tax. We have CGT, what we call capital gain tax, and we have withholding tax. I'm going to go into all these taxes in details one by one for us to have understanding of it. Now, I'm going to be quoting some relevant laws, and it's really just to see where the authority is being derived from. Now, there's one thing that's very unique. There's no taxman that can give you any assessment or any form of taxation outside the law. All these various taxes and levies are backed by the Act of National Assembly. Without those laws, nobody can enforce them. So, I mean, for the lawyers in the house, this is their area. So we go to the first one, which is the company income tax. The company income tax in Nigeria is governed by the Company Income Tax Act, called CITA, 2004 as amended. Now, this is a tax imposed on profit of a company from all sources. The normal base rate is usually 30% of total profit of the company. Now, but we're going to go in further, and you're going to see some differences that comes in. And then as we go on, when we go to the question part, I just want us to jot our questions so that we can run through, and then we can come back to the questions. Now, some of the profit, it's not all the profits that are applicable to company income tax. Some profits are exempted from company income tax, provided they are not derived from trade or business activities carried out by the company, e.g. cooperative society. But I'm going to explain this. I've seen a number of organizations where the owner of the company is transferring money into the bank account, and the taxman wants to tax it, or someone borrow them, like they take a loan from someone. It might not be a bank. Those are not taxable because they are not income that is generated from trade activities. So we know that, and then we continue. We're just starting up. And every company shall pay provisional tax not later than 3 months from the beginning of each year of assessment, which is an amount equal to the tax paid in the previous year of assessment. This is payment on account on the year's tax income assessment. Now, there are different ways which we're supposed to pay taxes, corporation taxes. So if, for example, last year, you paid a tax of over 1 million naira, from the first 3 months, the law says you should pay a form of provisional tax. So you look at, if let's say 12 million, let's say 1.2 million, just to make it easier. So the law is saying the first 3 months, you should pay like 300,000 an advance payment of tax. But those are technicalities. Nobody is really obeying it. We want to be practical and not just looking at what the law, what the textbook says. And when we say this is not applicable to Nigeria alone. Even the United Kingdom, even other parts of the world where this law is not usually kind of followed. And I'll tell you why it's not being followed, even when we go into another form of taxation, which kind of compensates for this. And we're going to see that later. But I want to before we go into due dates, I want to go into the Finance Act 2021, which talks about minimum tax. Now, this is quite unique. The only country in the world where I have seen minimum tax is actually in Nigeria. We've not seen minimum tax in any part of the world, but for whatever reason, Nigeria has, a provision for minimum tax. So, which means even without you making profit, they believe you have to pay taxes. And what they say is you have to pay 0.5% of your turnover as taxes. Now, according to Finance Act 2021, this has been reduced to 0.25 of the turnover, less frank investment income. And it will apply to any accounting period between 1st of January 2019 to 31st of December 2021. Now, this applies to any company making losses. This does not apply to any company making losses while in operation for the past 4 years. Oh, no. So if you've been making losses in the past 4 years, so you consistently, declaring losses, then the law says minimum taxes should apply to you because they believe you're deliberately saying you're making losses. But we're coming. There's a new Finance Act as well, which just been introduced in 2021, which talks about small company rates. And in that small company rates, the law says if you make a turnover of less than 25 million, so if you make 24,999,000, you're not supposed to pay any tax, any corporation tax, is zero. But if you make any revenue from 25 million, but less than 100 million, then you pay 25%. And if you make anything above 100 million, then you're supposed to pay 30% corporation tax. Now I'm going to go back a little bit and dwell on this more. So how do we come about the corporation tax? What gives rise to corporation tax? So as a business, you trade. So you have your sales and you have your expenses. You make payments, pay salaries, cost of sales. And when everything is completed, the profits that you made at the end of the year is what the government is saying you have to pay taxes on. Now, there are so many occasions where there might not be opportunity to make profits. So you make losses. And in different parts of the world, when you're consistently making losses, the law does not have any provision to say you must pay taxes. But in Nigeria, Nigeria is quite very smart with their own law. They make that provision to say if you're making consistent profit, consistent losses year on year, then there's a possibility that you are playing with the books. And so you have to pay taxes. This is the only part of the world where we have this. And obviously, it is to kind of take care of a number of things. So let's move on. Because this is not where we're going, really. I just want us to be familiar with some of the taxes before we start going to the meaty part of it. The second one is we have another form of taxes, is what we call the pay-as-you-go, payee. As the name connotes, payee is the tax paid by an employee after certain deductions allowed by law has been assessed. So when you have an employee, you're supposed to pay taxes on the salaries you pay them. Now, the law allows you to make some deductions. It's called reliefs and allowances. So these allowances are allowed to be deducted, and then the balance of the salaries is subjected to taxes. The taxes are graduated in different formats. Now, when you are a person that is in employment is not going to be responsible for the payment of payee, and this is quite unique. So for many of us that are business owners that run businesses, if we pay salaries to our employees without deducting payee, the liability is not on the employee. The liability is on us as an employer. Section 81 of the Section 81 of the Personal Income Tax Act describes payee as income chargeable on an employee by an assessment whether or not the assessment has been made, and which shall, if the relevant tax authority so directs, be recoverable from any emoluments paid or from any payment made on account of the made by the employer to the employee. So the employer is the person that's going to be responsible. So it's quite very important that we have a proper payroll system in place that can kind of, manage this, especially even as our staff kind of increases. An employee's income is subject to tax in Nigeria only if the duty of his employment are performed in Nigeria. So his employer is in Nigeria or has a fixed base of operations in Nigeria. Now, if my employer is in the UK, but I am resident in Nigeria for more than 180 days, then I am taxable in Nigeria. So it means I have to pay. So it doesn't even matter if my employer does not have a fixed base of operations in Nigeria, as long as my residence, your payee, the ability of the factor of you making a payee is a function of where you're residing. So, and we're going to talk about this more when we come to tax planning, which is the meaty part. I'm just making definitions. So we know We've talked about CIT, the company income tax, which is taxation of income for entities, which is for companies. Then we talk of payee, which is taxation of individuals. Now, both are very similar. The only difference is one is for company or, incorporated entity, and the other one is for individuals. Now, then, I think we talk about due date of filing. We're not going to really bother about that. Then we want to talk about another very important aspect of taxation, which is called value-added taxes. Value-added taxes is a tax that is chargeable on goods and services consumed by any person, whether government, agencies, business or organizations, or individuals. Now, there's one very particular unique area in value-added tax, which most people are really not aware of, and that is value-added tax is not a taxation is a taxation on an end user, not a taxation on a company. I'm going to give an example. So we have company A, which is producing, let's say fabric, it's producing shirts. Let's just say shirt. They produce shirts. For them to produce shirts, they need to buy materials, like, fabrics, buttons, and some other things. Now, when they buy fabrics, they pay VAT on it. The Nigerian current VAT is 7.5%. And when they buy buttons, they pay VAT as well on it. Now, what the VAT law says is, this VAT that they pay is recoverable back from the government because they are not end users. So as long as you add a value to a service, you are not supposed to bear the burden of VAT. Now, most organizations don't know about this. So let's say my raw material costs, let's say 100 Naira, for example, and I pay 7.5% of it, which is 7.5% is, let's say, 75 Naira. Okay? Oh, no, 7.5 Naira, 7 Naira 50 kobo. Okay? So I pay 7 Naira 50 kobo. And then I sell this particular fabric after making it. And I did sell it, let's say, at 200. At 200, I'm charging VAT on it as well, and it's 7.5. And the VAT I charge on it is about, let's say, 15 Naira. Now, I'm supposed to remit VAT back to the government because there's what we call input and output VAT. My output VAT is supposed to go back to the government because I'm just, as a business, when you collect VAT is not your own money. You're just an agent for the government. So when you collect VAT, you're not supposed to put the money you're supposed to spend. You're supposed to remit it back to the government. Now, this is where it got interesting. So let's say when you sell the goods for 200 Naira, and then your VAT is 15 Naira on it. Just an example. You're not supposed to remit the 15 Naira to the government. You're supposed to deduct the 7.5 Naira that you've already used in paying for the input, and then the balance is remitted to the government. Now, there's a very unique thing here for people that practice taxation that have business in the UK. I've actually had clients that had a refund because they do pay you refund here. So there's a possibility that you buy so much raw materials and your VAT input is higher than your VAT output. So when your VAT input, let's say instead of 7 Naira 50 kobo, our VAT input is about 20 Naira. And by the time we sell, we only sold our VAT output of 15 Naira. We are supposed to get a refund. The government is supposed to refund money back to us. Now, on the practical side of it, that's what the law says. In Nigeria, they do not refund. So we need to kind of get that. There's no refund in Nigeria. And in other countries, if you operate in the UK, they do refund you. The moment there's a time you're supposed to pay your taxes in the UK, for example, I'm just using an example just for us to have a form of comparative analysis of what the ideal should be and what we have in Nigeria. You set up a direct debit in the UK to pay your your VAT. The day you're supposed to pay, the money is taken from your account. If it's a refund, the money is put into your account. You don't need to call anybody, nothing happened. But we're dealing with Nigeria. In Nigeria, you've got to fill a paper. There's a paper form which has to be completed, and then you submit to FRS. If you have a credit, we've never seen a situation where credits are being refunded. Maybe if someone pushes for it and is ready to kind of follow up, possibly they might be able to refund. But in most cases, what people do is they normally carry over the credits, for the other period. So we go to the next slide, which apart from value-added tax, we want to talk about withholding tax. Withholding tax is another form of taxes, because this is what you normally see when the tax authority comes into your office. They look for, these are the different things they look at. Okay, I'm going to go back a little bit. The company income tax, the CIT, is administered by the Federal Inland Revenue Service. That is the federal government of Nigeria. Whereas the payee is administered by the state's Internal Revenue Service. So when an FRS person comes into you, except you work in Abuja, in the past, and I think that has changed over the last few years, FRS used to collect payee for taxes in Abuja, for payee taxes in Abuja, but that has been changed slightly now. They've created another FRS, which is strictly for Abuja and is responsible for collecting payee for Abuja residents. So in every state you are, if you're in Lagos State's Internal Revenue Service will be responsible for collecting tax, payee taxes for you. If you are in Ogun State, the Ogun State IRS will be responsible for collecting taxes from you. And this is how it works, not the Federal Inland Revenue Service. Now, when it comes to withholding tax is the unique tax that is collectible by both entities, whether states or federal. So the federal government, if you're a limited liability company, any withholding taxes that is due on any project or any work that you execute as a limited liability company is collectible by the Federal Inland Revenue Service. But if you're operating like self-employed or business name, business register, business registration, then the taxes are collectible by the state's Internal Revenue Service. Now, basically, what is withholding tax? Withholding tax is an advance payment of your income tax. So as a company, if you're supposed to pay CIT, the government is saying, we don't want to wait until the end of the year before you start paying us taxes. We want to start collecting our taxes almost immediately. So when you have a contract, especially when you have a contract of employment, as contract with some big multinationals, they make it mandatory that withholding tax has to be paid on it. So if you're a limited liability company and you're providing a contract that you rent or something, as a limited liability, you're supposed to withhold 10% of the value of the contract. And that 10% that you withhold, you're supposed to pay it to a Federal Inland Revenue Service. If you're self-employed or business name, which means you're operating as a one-man business, what you are entitled to, the taxes you're supposed to pay is the payee taxes or self-assessment, whatever name it is called. You are supposed to withhold 5% of the contract value and then pay it, to the State Inland Revenue Service. So there's a number of penalties that come with it. We won't go into all those detail, but there's a due date for filing withholding tax returns, and the late penalty is 25,000 for the first month, plus you still have to pay, the amount, and then 5,000 for each subsequent month. So if for whatever reason you're not aware that you're supposed to pay these taxes and you didn't pay it for a number of years, then you can imagine what your liability could be. It could really pile up so much, over time. And fines. So you have the penalties, then you have the fine. Then they put interest on it. And this is where, but we're coming to that. Let's just look at just the definition of what we have. The next form of taxes, let's move away from, withholding tax. We have the education fund. The education fund is governed by the Tertiary Education Trust Fund, Establishment Act 2011. It's a tax that is imposed on all registered company in Nigeria. And the essence of this taxation is for us to be able to fund tertiary education. It used to be 2% of your assessable profits. And I think recently it's been moved up a little bit to about, I think about 2.5%. Let's see. Just 1 minute. I'm just trying to. So yeah, so the amount in the fund is distributed between university, polytechnics, colleges of education. It's an allowable deductions in your computing of assessable profits. And it used to be 2%, but it's been moved review upward to about 2.5%. And this is also administered by the Federal Inland Revenue Service. Now we have capital gain tax. And we will say, what is capital gain tax? Capital gain tax arises when you have an asset that you dispose. And you'll be surprised that if you buy an asset, and let's say you have a house, and by the time you bought the house for, let's say, 100 million naira. And by the time you're selling the house is appreciated, and you're selling it for 200 million. The law says you're supposed to pay taxes on the profit that you made from the proceeds. So capital gain tax is a tax on the profit obtained from the disposal or exchange of a certain kind of asset. The tax rate is 10% on capital gain. So if you get a house for 100 million, you sell it for 200 million, you're supposed to pay 10% on the 100 million. And this is regulated by the Capital Gain Tax Act. It's administered by both federal and revenue and the state, depending on who is selling the assets. If a company is selling the assets, then the payments is collected by the Federal Inland Revenue Service. If an individual is selling the asset, then the State Inland Revenue Service will be the one that collects the taxes. Now, the Finance Act made amendment to capital gain tax in, capital gain tax 2004, and provide for gains accruing from disposal of stocks and shares in the Nigerian company. Now, until this Finance Act 2021, if you sell your shares, you're not supposed to pay capital gain tax on it. But that has changed. So if you buy an asset, if you buy shares of, let's say, GT Bank, and by the time you sell, let's say you buy it at 10 naira per share, and by the time you're selling it, the share is about 15 naira. The 5 naira difference, you're supposed to pay 5%, multiply by the number of shares you have on it. That's the new law that comes in. That's the new Finance Act on stock. So before, you don't pay anything, but now you have to pay on it. Now, then we have the police tax, which is quite funny. So essentially, because I'm sure many of us were going to be surprised, is there any taxes for the police? Yes, there's actually a police tax. It's a trust fund designed to provide funds for the training and retraining of personnel of the Nigerian police. The Nigerian Police Trust Fund Act 2019 is amended by the Finance Act 2021 to empower the FRS, that is the Federal Inland Revenue Service, to assess, collect, and account and enforce the payment of stipulated percentage of 0.005. It's a very small amount of the net profit of companies in Nigeria into the police trust fund. Now, when you look at all these taxes, and this is like the various taxes we have. If you look at all these taxes and the motive behind them, they are actually, designed to really help the country. If we are able to like provide this small amount into the police trust fund, which means we can have proper training, we can have proper facilities for the police. If we're able to get 2.5% of corporation taxes into universities, it's enough huge amount of money that can help company take care of the public higher institution. Anyway, whether that one is happening or not, we're not going into that. Now, this is where we come back to the meaty parts of this discussion. Now, we've seen all the various forms of taxes, at least the basic ones that are applicable to everybody. Now, the question is, how do we develop an effective tax compliance framework to make sure that our organization is rightly positioned? And at times when you look at it, even maybe before we actually talk about how do we develop this framework, should we look at the advantages? Or maybe we should start with this, because I want to say, should we try to see the joy? Because when we say, why do I want to pay all this amount of money? What am I going to gain from it? And so I'm thinking maybe we should possibly look at benefits, then we can look at how we're going to do it, because that will motivate us to do a lot, because the cost to us. So I will go in and say, let's look at the benefit of tax compliance. If we have an effective tax compliance, it can save us a whole lot of money. I do remember that in Nigeria, we've had to deliver some job for some clients that were given about 100, I think almost 158 million naira tax liability. And with proper planning, we're able to kind of change this to less than 2 million naira. Now, I wouldn't even call that significant savings, because those amounts that was put up by the Inland Revenue Service were not really genuine. But with the proper planning and proper management, you can actually carry out a number of things that will provide savings for you, because every tax law always have a loophole. Now, the lawyers in house will probably be aware of this. For every tax law, I don't know, in every country, there's always a loophole, as always inserted in every tax law. It's now up to the taxpayer and the tax advisors to be able to exploit this loophole and maximize it to their benefits. So when you have effective tax compliance, you can do significant cost savings. Now, one of the benefits of an effective tax compliance framework is that it helps you to manage your cash flow, your cash flow. Now, a company being profitable is nothing. It's good to be profitable, but cash is king. We all know cash is king. When there's no cash, cash flow is the lifeline, is the blood of any business. So if you end up with a huge tax liability that is not properly managed, you might end up with a huge payment that might have significant impact on your cash flow. So you might not be able to purchase your assets. You might not be able to manage your working capital because you have to pay taxes. And I tell you, taxes could be in a huge amount of money. They're not small money. The third one, it makes us to be a responsible corporate citizens, because then our hands are clean, we're fulfilling our duties, whether as a corporate citizens or as individual citizens. And paying our taxes also position us strongly to be able to put our bid in some, there's some bids in Nigeria now that you need your personal tax clearance, I need your company tax clearance before you can actually participate in them. There's so many bids, even in the private sector. The private, not only the government, there's some big corporate private sectors are always asking for tax clearance before they allow you to participate in some procurement bids. So it's very important. It's not just like, I'm just doing it because I want to be. It's good to do it, but for you to actually generate revenue, you actually need to do that. Now, complying with various OECD and financial reporting standards, now we've seen that even the countries that are saying they're not really bothered about taxes, like Dubai, from next year now, Dubai is going to introduce corporation tax from next year, 2023. They've introduced VAT at 5% for the past 5 years or thereabouts. Now they're introducing corporation tax. We don't know what level they might get to. They might get to a level where they're introducing personal income tax as well. But for now, they have VAT running. From next year, they're introducing corporation tax. So taxation has come to stay in the whole world, and there's no hiding place. So it allows us to actually be compliant with the OECD, which is the main, organization that kind of govern all the businesses around the world, especially in the Western world, and some financial reporting standard. Now, ability to confidently source credits, especially offshore finance. If you want to attract finances, either from, international banks, if you're not paying your taxes, they don't want to know how good your organization is. They don't want to know how good your cash flow is. They don't want to know how good your business is. They're not going to have the confidence to be able to kind of provide such financing for you. Even in Nigeria, I don't know how much the Nigerian banks are pushing, but abroad, if you want to kind of get offshore finance, your taxation, your tax compliance is very important. Now that we've seen some of the benefits, so we'll go back and try to see how we have an effective tax compliance. Because when you look at the merits, one of the things you could have is the merits. Is if you don't have, I said number one, let's develop a very robust tax strategy. Without a very robust tax strategy, there's a possibility that you're going to pay so much money. I'll give an example. I have a client who came from Austria to set up a business in Nigeria once. And this is quite important because, as Nigerians, these are not things we ever do. When the guy got into Nigeria, he wants to go into heavy equipment business. He wants to be selling, caterpillars, payloaders and all this heavy equipment. The first thing he asked me, he called me into a meeting, asked for me to explain all the various taxes we have in Nigeria, just like what we just given earlier. I did explain everything. And the question he asked me is, if I'm resident in Nigeria, how long do I need to stay in Nigeria for me to pay taxes in Nigeria? Okay, now this is what I call he's trying to develop the type of tax strategy he wants to do. Whether he wants his company, so before you even register your company, if you really want to make an effective use of tax compliance, and you want to kind of maximize savings from tax, is to look at what tax strategy do I want to have? What is my overall tax strategy? Do I want to, have a resident? Obviously, if you're a Nigerian, you have to register a company that is resident in Nigeria. How do we want to what are the top level strategic objectives we want to achieve in terms of our taxes? Because you have tax objective, just like we said, what is the objective of an organization? We say it's to maximize profit for shareholders. I've changed that actually. I believe it's for stakeholders, not for shareholders. Because, before the shareholders get any amounts in the profit of an organization, everybody has gotten the suppliers, the employees, even the government will have picked something before the final shareholders are able to. So the first question is to say, what is our tax strategy? What's our tax objective? What do we want to achieve? So we can say our strategic tax initiative is that we want to be tax compliant. We want to maximize all the laws. Now, it's funny. Some people might say, yes, I know there are some loopholes in the tax laws, but I don't want to exploit. I just want to pay. If they say my tax bill is 100 million, I just want to pay the 100 million. Some people want to say, if they say my tax bill is 100 million, I want to explore all the legal framework to optimize my tax position. So if my optimized position, if I'm able to get 50 million optimized position, I've been able to save it. Now, after getting that 50 million optimized tax position, do I want to pay it immediately or do I want to spread it? And that's where the cash flow comes in. Some organizations, some corporate fine might say, we're just going to pay it. We don't care. We have very good cash flow. We're just going to pay it. Some might want to say, if the law allow me to spread the payments, then we want to shred the payment. Now, this is how we start kind of developing our strategic initiatives that want to govern our tax strategy. Now, when we've kind of defined what we want, which might be with the help of our tax advisors, another very important thing is to have a very good tax advisors. Now, what I've discovered in Nigeria is most of the time, organization and individual feels, I can't pay so much to get a tax advisor. I'm going to do it myself. And then there's another very dangerous thing, which I would like to point out today. We might have some of us that work with the Inland Revenue Services, but it's a conflict of interest for an official of an Inland Revenue Service to provide advice to a tax client. It's a conflict of interest. It's not supposed to happen. In Nigeria, it does happen. People just say, oh, I'm going to help you. But I can assure you that it's not the right decision, because like some tax authorities in Nigeria, they have a target. They give them a target. This department needs to bring in XYZ millions of naira. So if they give them the targets to bring in revenue, and these same people are the one advising you on your tax planning and tax advisor, and they are your tax advisors, you can be sure that they're going to advise you in such a way that is going to favor them, so that they're going to get enough to be able to meet their targets. So it's always good to get an independent tax advisors who are versed in taxation in Nigeria, and they'll be able to kind of help you to provide. So selecting the appropriate tax advisor is very important. The third one, which is as equally important as the first two, is effective tax planning. So what is effective tax planning? Is before this beginning of the year, I want to know I've looked at my strategy. This is the top level strategy I want to have. Now, what are the planning phases that we need to go into it that will make us to achieve it? So for example, I'll use that client, the Austrian guy. So what he did was, he looked at the taxi because he was living between Austria and Nigeria. Now, if he spent certain days, now because the Nigerian system is patterned after the British tax system. Because in the United Kingdom, if you spend 180 days, then you are liable to pay taxes on your income in the United Kingdom. In fact, in all over the world. But if you decided that you're going to spend 179 days, then your income is not liable to taxes in that country. The same thing in Nigeria. Now, there's a particular thing that happened in Nigeria, which is very unfortunate, is that the taxman in Nigeria will want to play on your ignorance. And even if you spend only 90 days in Nigeria, they want to tell you, because you're a Nigerian, that all your income all over the world should be paid in Nigeria. And that's not happening, because you're probably spending more time in another country than you're paying. Unless you spend 180 days, which is six months, then you are not liable to pay all that. So that's quite important. So what the guy did was, he was now looking at, where do we have the lowest tax rates? Is in Austria, is in Nigeria. And he even got to a level that he said he was planning to open a company in Dubai. And because Dubai has 0% income tax rate, he has decided that he's going to spend most of his days in Dubai, so that he's going to avoid, and this is not tax evasion, this is tax avoidance, and it's a legal thing. So that he's going to spend so that he was not going to be liable to personal income tax in Nigeria. He's not going to be liable to personal income tax in Austria, but he's living in Dubai, and Dubai has 0 tax rates. Now, he has not even started anything at all. He hasn't started doing anything. He was just planning. This is what he's going to do. That is the first part that he was looking at. The second thing, and the same thing applied to an entity. So you have, what they call permanent establishments of an organization. So some organizations are like, they're permanent establishments. So if you are representing an international organization, there's a way that if they are not permanently set up in Nigeria, there's a way that you can play with your taxes as well. You know, what you pay, what you don't pay. You know, it's a bit complex, but depending on what you do, you can kind of play around with it. Then another thing which is very important, part of your tax planning is your VAT. Now, I will tell you this. When you talk about corporation tax, people think you pay more in corporation tax than you pay in VAT. You actually have more liability in VAT than in corporation tax, because by the time you run your business, you can declare a profit of, you can have a turnover of, 1 billion naira. And you said at the end of the day, you said you only made profit of 10 million naira, and you pay taxes on that, or even 1 million, because it's possible. You can even make losses. But when you make a revenue of 1 billion naira, look at 7.5% of that 1 billion. That is your VAT liability. Now, that's a lot of money that you have to, refund back to the government. And this is where the whole tax planning comes in. So you must be able to make an effective planning on how you're going to use your input VAT. So for organizations that has a lot of raw materials, they must be able to make sure that they develop a robust system of getting VAT inputs that can net off their output, and it can reduce the amount of money they have to pay, significantly. Now, so tax planning is a lot. There's a lot of things that goes into it, depending on what you're doing. The same thing with your employees. For example, in the UK, you see some organization, they will tell you your salary is £100,000 and your bonus is £100,000. Now, in theory, what they want to do is, you want to say your salary is £200,000, but because you're going to pay taxes and national insurance on the 200,000, they decide to cut your salaries into two and give the other one as bonus. The same thing in Nigeria, you can benefit from it as well. There's a way you can kind of calculate some amount and say, okay, this is going to be salaries and this is going to be bonus. Now, in payee, benefit in kind, so if you give a car, house, these are all taxable. They're supposed to value them and add them into your employee salaries. But there's a way with effective planning that you can reduce personal income tax on that area. Now, the fourth one is tax implementation processes. So when you have all this, planning, strategy, appointed a tax advisor who could be your employee in-house or could be an external person, depending on how, the strategy you have. Because your strategy might be that some organization strategy will be, we don't want to have an in-house tax advisors. We want to outsource it. And some people will say, no, we want to keep it in-house. That's part of the strategy. Now you look at the implementation process. How do you implement it? How do you carry it out? You make sure that your taxes are filed on time. There's a significant amount of money you can save by making sure that your taxes are filed on time, the payments are made on time. One very unique thing about taxation is not even the payment, it's actually the filing. So even if you fail to file and you have nothing to pay, you still get penalty. So the timing is very important to make sure that you make savings. So this is where the whole implementation process is coming. Then when you have all this, it's always very important to look at the periodic monitoring. How do I monitor what I'm doing? I've put in the tax strategy. I've had an appropriate tax advisor, whether inside, whether internal or external. We've had an effective tax planning. We've developed implementation process. Now, there's a need to have a report. Your report could be quarterly, it could be every 6 months, and it could be annual. In fact, I would suggest quarterly, 6 months, and annual, so that you feedback, you monitor, am I really making savings? Are we paying penalties more than we should? And how can we, perform better? The tax advisor that am I using, is it competent? Is it doing the right work? Is it compromising, the integrity or the process that we put in place? Because this could happen. So these are the various ways we can kind of look into this. I will kind of pause a little bit here, and then ideally we should look at a bit of a practical practical scenario, but maybe if we come into question and answer time, that will help us to give a bit of practical scenarios analysis that we can kind of play around. Thank you.
Thank you so much, sir. Thank you very much. Very, very insightful and detailed. Before we come back into questions, so what I would like to ask at this time is, and I know there are definitely questions, there must be questions because we have lots of business people, business owners, professionals on the call. So what I would like to ask is, you can put your questions together. Two options, you can drop your questions in the chat room, or on the alternative, you may want to raise your hand and we will take it. While we're doing that, there's a comment, I'm not sure, it's from Eileen Irene Efue. It says, many feel that penalties for not paying taxes are very high. After 3 years of starting and running a small business from our house, the young housewife decided to go to the tax authorities to put her tax house in order. What she got was a tax penalty of over 800,000 naira, whereas her actual tax was 100,000 naira. What are your thoughts on this, please? And is this the international norm? Thank you.
I would say no, just to kind of answer that question straight away. That is not an international norm. In fact, in the people that were actually copying their taxation system, that's the whole essence of the tax man is to help to develop a business, because the better the business perform, the more tax revenue that the government can derive. On the other hand, if they decide to, it's like killing a cow that is making the milk, that is manufacturing the milk. Once you kill the cow, you can't get anything out of it again. Unfortunately, the taxation system in Nigeria is not completely different from the entire system that Nigeria operates. And we know our system is not that very perfect, and just being kind of mild in the way we put it. And this is why at times, as much as people want to do the right thing, we have this very difficult situation with the tax authority that's making it quite very difficult. And this is one of the reasons why I would say, you see, depending on the size of the business, I would suggest, it's always good to kind of possibly speak to an advisor, a professional tax person that can go in and kind of, represents. It's just like a lawyer representing a client in the court. And that's how it's been. Like I said, I think I mentioned it earlier, that, if you go to the tax man for advice, one, according to the best practice, the tax man is not supposed to advise the tax client, because that is a conflict of interest. So that's one. So it's not as if, a tax consultant or a tax advisor is trying to get business for himself or herself. It is that is a conflict of interest for the taxman. There's supposed to be a complete segregation of duties. They're supposed to do their work, and someone else is supposed to be able to advise those people. So in a situation where they're doing that, that's what, because they have a target too. So on this occasion, I believe the only way that the person the best option available to the person is to actually find an advisor. Now, the thing about advisor is, depending on the size of business, even the big, the very big international firms have developed, a small, medium scale business unit where they make sure that the fee is not the fee they're going to charge the big corporations. So they're able to say, you know what, this is how big, small your business is. We're going to charge you these amounts, but we're going to be able to create value for you back. And a very good advisor should be able to create value for you. So if they're charging you X, Y, Z, They should be able to give you XYZ plus back as a value, so you're not losing. I don't know if I'm able to answer that question appropriately.
Thank you, sir. Thank you very much. I think so. I mean, if the person has further clarification, she can put it up. But there's another question here that I also like personally, so I think I'll join the person asking. So what criteria or yardstick do you use to determine the tax advisor is up and doing? And so I'll add to it. So, I mean, around here, my personal experience has been sometimes it's difficult to even measure what is being done because you pay, even when you do pay, at the end of the day, sometimes you get letters from, I mean, you filed for 3 years ago, then somebody shows up and says, oh, we need to do a tax audit over the last 3 years. While you're at that, you get a similar letter from another office for the same years of assessment, you know. So, and your consultants or your auditors, you know, they are doing, I mean, you have a feeling they are doing their work, but sometimes it's difficult to even measure because of the environment. So, how would you advise that we measure whether the advisor is up to, you know, because as you know, the advisor will always come back and say, well, we've represented you and this is what government is saying. So our advice is that you pay up, even when it's not reasonable sometimes.
I'll give an example. We represent, you know, in my firm, we represent one multinational, which is a British multinational. It's a multi-billion pounds business based in the UK, but they have a very strong presence in Nigeria. And according to the British law, you know, there's the Anti-Bribery and Anti-Corruption Act, which criminalize and penalize any British organization and individual to pay or receive bribe in any country, wherever they are. So it doesn't matter whether it's outside the UK, they could penalize for it. And then we have this situation where we have tax authority coming up with some huge amount of money and asking them to pay. And the first thing they say is, we want you to look into it. So I'm going to say one thing. One of the very difficult things to do is to use time as a benchmark for measuring the performance of a tax consultant. In Nigeria, that is an impossibility. So I need to kind of state that one very clear. So if you're going to say timely, because when you want to kind of set a KPI, you can say timely resolution of XYZ. If you want it to be properly resolved in Nigeria, you need to remove that time completely, because the tax authority will try to drag it as much as possible. So it's like someone say, if you want a microwave food, then it's not going to be a properly cooked meal. So if you want a properly cooked meal, you need to be patient. But I'll give you some few KPIs that you can use to measure an effective tax consultant. The first one is timely submission, because there are some penalties that are actually, you know, the taxpayer's error. So if they ask you to submit your payee, payroll at so time, your VAT as XYZ time, when you are late in submitting them, they will come up with penalty. So this is where people start saying, oh, please help us. Then this, no. But if they ask you to say, you should submit by 21st of the following month, then you submit it be on or before, and everything is up to date. There's no way a taxman can penalize you for late submission. They might say, oh, you should have submitted more, which you can argue. So the first thing is timely submission, if depending on what you entrust to them. The second one is the level of penalties and fines that you receive now, or that you eventually pay. I'll give you an example. I've seen so many tax advisors in Nigeria that will always tell you, you know, and I think the lawyers do it as well. There's some lawyers, I watch some US attorneys, the way they work. They're always going to plea bargain. Oh, just plea bargain, we handle it, take this, and then we go. Now, there are some tax advisors like that. They always tell you, no, let's settle. And then they settle. Now, and then you pay penalties, you pay fine, and then you make everybody happy. If you continue to do that, the relevant individuals will turn that clients, whether an organization or individual, they will turn them into a meal ticket, and they will continuously milk them. So it's always good to say, I want to do the right thing. And I tell you, it is not impossible to do the right thing. We've done it. We've seen organizations that says, I'm not going to pay a penny as bribe, and I'm not going to pay a penny as fine. I want to see if I broke the law, and I mentioned that earlier. I said the taxman cannot go outside the tax laws. That is the Bible of taxes. There's nothing, there's nobody, there's nothing, as long as it's not within the tax law, it cannot be enforced. So a good tax advisor that knows this onion and know how to interpret and manipulate, I don't want to use the word manipulate, but I know how to dice and they will know. I'll give an example. And this is not in Nigeria, but it's quite similar on how you can see how a good advisor is. We had a client who had a tax liability. It's a very small business of about almost £200,000. Now, this is in pounds. And the revenue was so small that these taxes was not justified. But it was because there was no tax planning. The tax advisors were just working. Whatever she submits, they just put it in. And she was borrowing money from her company. Now, under some certain tax laws, when you borrow money from your company, you're supposed to pay a tax on it of about 32.5% on the loan you took from your company until you pay it back, because they realize that, close company, that's company like maybe you own your company, you are the shareholder, you are the director, so you can withdraw money from your company anyhow. They will not want to call it drawings, they call it loan, and they will not pay it back. So they start charging them taxes of 32.5% on it. This lady had an accumulated taxes of about £200,000, and it's been submitted if she's filed for so many years. And there's no way she could do it. She could do anything, but she has about 3 houses that are in her name, not in her company name, And those houses, she's consistently making losses on them because the tenants are not paying. So she's making losses on these properties, and she's paying heavy taxes on a very small income. So when we were engaged and we joined in, and I asked her, can you pay this money back? She said she can never pay the money back. So what we did was, we asked her to transfer, because she's the only sole owner of the company, so she transferred to the company. And that net off alone. So what I'm trying to say, there are different ways as a tax advisor that you can play within the law and save your clients money. So I think one of the main things is reducing significantly penalties and fines, and not, settling out of whatever it is. And then the third one is resolve cases. If we have, how many cases has the tax advisor been able to resolve? Do you have many cases that you keep on moving over from years to years and it's not resolved? I think this is one of two things. But one thing that you must not use to judge a tax advisor in Nigeria is the time. Because some of this will take so long. In most cases, the client will say, you know what, I don't want to drag it anymore. Just give them whatever they want. But if a client is ready to drag it out, yeah, and once they know this is who you are, over time, they kind of respect you for it.
So I see one more question from Mr. Tunde Akode, and he says, can our speaker shed light on the Finance Act 2020 as regard payment of VAT on real estate sales and acquisition, real estate, particularly by the real estate development company?
Yeah, this is one area of the Finance Act that is a bit kind of I don't know how to call it. It's a bit funny, because in every part of the world, because when you talk about the VAT framework, we actually borrow the whole VAT framework from the OECD countries. Now, real estate is not supposed to be, it's not a vatable sales, because it's You're not supposed to pay VAT on real estate. I know the Finance Act has been, I think in the quest for government trying to, increase their revenue, and this is what we kind of talked to, they did mention. I think they started at rent. They should start charging VAT on rent, and they should start charging, VAT on real estate. So when you purchase a house, then you pay VAT on it. I mean, the truth is, I'm going to I'm not going to speak so strongly on that, because I believe is an area where it's kind of contestable. And according to the VAT Act itself, now Finance Act is like a guideline. It's not really the act itself. It's a guideline, and it changes from year to year. I've not seen what is said in 2021, whether they still, retain it. But so far, I've not really seen any clients that has been complying with paying VAT on real estate sales and acquisition of real estate. I have not seen it. If the speaker wants to talk to me later on this, I would like to shed more clarification on that, but I would like to take that off, and share more clarification on it. And we'll look at it vis-a-vis what Finance Act 2021 is saying. But one thing you need to know is Finance Act is not, it's not really the VAT regulation itself.